Good morning, students. Happy morning to all. As per Davangere University Corporate Law, third semester BCom, under the session 24, I am explaining of Module 3 Managerial Personnel of a Company. Topics covered: duties and responsibilities of a company directors. Learning objectives. Main objectives of this session is to understand the concept of duties and responsibilities of a company directors. In the previous session, we already discussed in regarding to appointment, position, rights, duties and liabilities of a directors. Of session outcomes. After studying this session, you should be able to explain the concept of duties and responsibilities of a company directors. Now let us start with the duties of a company directors. Duties of directors under the New Indian Companies Act 2013. The duties and responsibilities of directors stipulated by the Indian Companies Act of 2013 can broadly be classified into the following two categories. First, the duties and liabilities which encourage and promote the sincerest investment of the best efforts of directors in the efficient and prudent corporate management in providing elegant and swift resolutions of various business related issues, including those which are raised through red flags, and in taking fully mature and wise decisions to avert unnecessary risks to the company. Prudency duties which ensure and secure that the directors of companies always keep the interest of the company and its stakeholders ahead and above their own personal interests. The following are duties and liabilities have been imposed on the directors of companies by the Indian Companies Act of 2013 under its section 166. A director of a company shall act in accordance with the Articles of Association of the company. A director of the company shall act in good faith in order to promote the objects of the company for the benefits of the company as a whole and in the best interests of the stakeholders of the company. Now, further duties are: a director of a company shall exercise his duties with due and reasonable care, skill and diligence, and shall exercise independent judgment. A director of a company shall not involve in a situation in which he may have a direct or indirect interest that conflicts or possibly may conflict with the interest of the company. A director of a company shall not achieve or attempt to achieve any undue gain or advantage either to himself or to his relatives, partners, or associates, and if such director is found guilty of making any undue gain, he shall be liable to pay an amount equal to that gain to the company. A director of a company shall not assign his office, and any assignment so made shall be void. If a director of the company contravenes The provisions of this section, such director shall be punishable with fine which shall not be less than 1 lakh rupees but which may extend to 5 lakh rupees. Now next concept is independent directors. The liability regime of the Companies Act 2013 not only imposes the above mentioned duties and responsibilities on the directors of the Indian companies but also advocates for independence and equitableness of the board of a company, especially a public limited company. Consequently, the roles, duties, and responsibilities of the independent directors have also been stipulated by the New Indian Companies Act of 2013. An independent director is that member of the board of a company who does not possess any financial relationship with the company except the sitting fees, nor can own shares in the company. The earlier Indian Companies Act of 1956 had no explicit provisions for the independent directors, and only the old class 49 of the listing agreement of SEBI contained prescriptions for induction of independent directors to the listed companies. The New Indian Companies Act of 2013 dedicates that every listed company must contain at least one third of the total magnitude of its shareholders, of its directors, as the independent directors, and it also empowers the Government of India to include other categories of companies within the scope of this provision or requirement under Section 149 of the Companies Act 2013. Public limited companies composited as per the Farmer Companies Act 1956 are granted a transaction period of 1 year for making strict compliance with this mandatory provision. Again, the independent directors are not permitted to hold office for more than two consecutive terms of 5 year periods. Next, in the new regime, the roles and duties of the independent directors attained significant expansion, and many new other areas have been prudently covered. Broadly, they are intelligently assigned the highly responsible role of the attributors among various constituencies within the corporation. Hence, the new provisions for the independent directors of the limited companies are certainly very conservative for transparent and sound corporate governance, and are ugly beneficial to the company and its all shareholders. Some of the most significant functions, duties, and liabilities of the independent directors are the following. It is as per the Schedule 4th of the Companies Act 2013 to assist in forwarding equitable and independent judgment to the board, to secure and to promote the interests of all stakeholders of the concerned company, particularly of the majority shareholders, to conciliate and balance the conflicting interest of the stakeholders, to attend actively and conservatively most of the board and committee meetings, to pay proper and adequate attention to related party transactions, to report concerns honestly and impartially about any unethical behavior, violation of the code of conduct, or any suspected fraud in the company. Now let us start with the responsibilities of a company directors. In addition to the general statutory duties outlined above, the Companies Act 2006 and other sources of legislation, example employment, health, and safety licensing, data protection, environmental, as well as any service contract that may exit impose a number of important obligations on a company director. These additional duties, many of which are administrative in nature, arise from a director's responsibility to ensure that the company itself adheres to its statutory obligations. They include first, registering for business tax. Within 3 months of starting to trade, a limited company must register with HMRC for corporation tax. This can be done online. It may also be necessary to register the company for other business taxes and HMRC services such as VAT, PAYE, and the construction industry schemes. If you are if your company has employees, you may have to operate pay as you earn to deduct income tax and national insurance contributions from employees' wages. At Quality Company Formations, we offer a pay registration service for $19.99 plus VAT as an optional extra to all our company formation packages. If your VAT taxable turnover exceeds $85,000 in a rolling 12 months period, or you want to register voluntarily, Quality Company Formations includes a VAT registration service with your complete package. Now next, filing an annual confirmation statement. At least once every 12 months, company directors are responsible for filing a confirmation statement with Companies House. This document, which was previously known as annual return, is used to confirm that the information held at Companies House is correct and up to date. Directors must check and confirm details of directors, shareholders or guarantors, the company secretary, if any is appointed, and next people with significant control, the registered office, the sale address, the location of statutory records, the SIC codes, company shares to help you to stay on top your important directorship duties. Quality Company Formation provides a confirmation statement service for $34.99 plus VAT. So another filing annual accounts with the Companies House to report a company's trading status and financial activity. Directors must file annual accounts at Companies House. The first account should be delivered 21 months after the date of a company formation. Subsequent annual accounts must be filed with Companies House 9 months after the end of the company's financial year. Document companies, that is, those which are not trading, have to file the doormat accounts with Companies House to ease the administrative burden placed upon directors. Quality Company Formation offers a doormat company accounts service to all UK limited companies for only $39.99 plus VAT. Filing company tax returns and annual accounts with HMRC. Annual accounts must also be delivered to HMRC as a part of the company tax return, which is used to work out and report how much corporation tax, if any, the company owes. The filing deadline is 12 months after the end of the company's accounting period for corporation tax. Directors must ensure that any corporation tax owned by the company is paid no later than 9 months and 1 day after the end of the corporation tax accounting period. Please be aware that the deadline for paying corporation tax is before the deadline for delivering the company tax return and accounts to HMRC. Many new directors get caught out by this. Regardless of whether an accountant is appointed to take care of your company's bookkeeping, accounting, and tax return requirements, the director is ultimately responsible for ensuring that all filings and payments are accurate and made on time. Reporting company changes. Company directors are responsible for reporting certain changes to company's house, including change of registered office address, use of sale address, appointment or removal of a director, change of director's details, appointment or removal of a company secretary, change of secretary's details, change of shareholder or guarantor details, issue of new shares, change of location of statutory records, change of company name, change of articles of association, registration of charges, change of PSC details. Director should also tell HMRC if the company's contact details change or when an accountant or tax advisor is appointed. Now, this is an end part of this session. Summary of this session. The New Indian Companies Act of 2013 is certainly a very innovative and landmark legislation in respect of the duties and responsibilities of the directors of a company. Also, both the board directors, both board categories of directors, namely the directors having a peculiarly relationship with the company, and the independent directors have been properly considered under this mature legislation for directors. It is quite obvious from above illustration that the Companies Act 2013 sincerely seeks to make the corporate management and governance in India rather efficient, fully accountable, transparent, and maximally beneficial to all stakeholders and related professionals. Through this intelligence legislation over duties and responsibilities of directors in Indian companies. Thank you. Thank you to one and all.